Ladies and gentlemen, good morning. Welcome to what's now become a regular annual investor conference for Xstrata. Our intention today really is to provide you with as much detail as we can about the progress of our strategy since the last time we had this conference, and certainly since the last time we met you at our results. And the way that we'd like to do that, of course, is directly from the people who are on the ground delivering the prolific organic growth pipeline that is now unfolding at a rapid pace at Xstrata. By now, you'll be very familiar with our strategic framework, which is made up really of three pillars. In the early days, as you know, mergers and acquisitions were the primary way in which we delivered growth, simply because we were small, and that was the only way we could deliver growth. Secondly, what we did, as you know, or what our operating teams did, is took the assets that we'd acquired and very rapidly improved their competitive position, moving them down the cost curve, restructuring them, extending their mine lives and resources. What was less well known, of course, was that all through this first phase of our strategy, we were accumulating a set of organic growth options, which we were nurturing even through the downturn. And what you're going to see, most of what you're going to see today really is the natural unfolding of our strategy from an M&A-led strategy through to a strategy where the center of gravity is going to be organic growth. That doesn't mean the other two parts of our strategic construct are not going to be in play. M&A will always be a part of what we do if we can find a way to extract value and create value through M&A. Operational excellence is a continual quest in our business, but in reality, organic growth really is now the center of gravity for Xstrata's development. We've already completed over $11 billion of projects which are commissioned and running. We have $14 billion of projects which have been approved and are now in implementation, which are targeted to deliver the 50% volume growth that we had flagged last year. And we have a further $8 billion of projects which are soon to be approved when they reach the appropriate approval stages, which could deliver in total 80% growth to 2016. So a very exciting prospect. You'll hear much more about it in detail and what it means overall from our team. So I don't want to spend much more time on that other than to say that since the last time we met in our results, we've approved 5 more projects, including the announcement we made this morning, which is the world-class Ravensworth North coal project in Australia. Now, in terms of the order of play today, we're going to start with Trevor Reid, our CFO, who will give us an overall view of the implications, financial and otherwise, of this organic growth pipeline that is now, as I said, rapidly unfolding. We'll then have presentations from each of our business unit CEOs and their teams. We do that in typical egalitarian fashion in alphabetical order, so we'll be starting with Alloys, with Piet Nienaber. They will present, and then there'll be a short period of Q&A after each of the CEOs have presented. We will take a comfort break at 12 o'clock before we then return for Peter Freyberg to present to us essentially the coal strategy, but also a member of his team, Mark Eames, will talk to us about the new exciting iron ore entry that we've made over the last year. After lunch, we will then take another break at 3 o'clock, and we'll close with Mick Davis, who will join us then to provide us with an integrated view of the implications for our company and our strategy unfolding over time. Thank you very much. Trevor?
Well, good morning, ladies and gentlemen. I was told that we had about 170 acceptances this morning, so I'm pleased to see that we haven't lost too many through the people who were watching the Ashes last night. And congratulations to England, and I guess to South Africa on such a fine win. As Thras has mentioned, today we are going to mainly focus on our project portfolio, and we're fortunate to have the 5 key members here who run our businesses. These are the people who really create the value at Xstrata, and consequently I'm going to keep my introduction very brief. But I think that what we do want to achieve today is to leave you with a high degree of confidence and assurance that we can do three things. Firstly, that we have the operating and technical capability within Xstrata to deliver on this exciting project portfolio. Secondly, that we have done everything prudent to de-risk these projects before we've announced to the market that we are ready to develop them. And finally, that we have the financial capability to embark on what is such an ambitious growth profile. Just to follow on from what Thras said.
Well, good morning, ladies and gentlemen. Thank you, Trevor. As you know, the chrome and the PGM operations are all South African based, and they employ approximately 16,000 people. The Bushveld Igneous Complex, which is regarded as the world's most valuable geological intrusion, is host to the world's largest chrome and PGM resources. Our chrome operations produce some 5.3 million tons of chromite, and from our smelters, we've got approximately 2 million tons of ferrochrome capacity. Our PGM business is currently very, very small, producing some 115,000 ounces of platinum, but it is expected to triple when Eland Underground mine achieves steady-state production. Our geological position and diverse asset base across the western and the eastern limbs of the Bushveld Complex give us a significant advantage in capturing opportunities as well as leveraging key inputs such as skills, power, water, all of which are scarce in the mining sector at large. While our focus in 2010 was primarily to restore the business to profitability, which we've done successfully, we have also been able to firmly establish a platform for future growth through the following projects. Project Tswelopele will provide an additional 600,000 tons of pellets and sintered product, and the Eland Underground Decline project is well on its way to produce the projected 313,000 ounces of platinum. And finally, Project Lion Phase 2 will deliver additional 360,000 tons of ferrochrome per annum using Xstrata's priority premise technology. These projects represent collectively about $1.3 billion of capital investment and will, in addition to growth, consolidate Xstrata's cost leadership position. While volume growth will drive efficiency in the PGM business, the chrome business is subject to much more innovative interventions. In this regard, Xstrata continues to explore ways to improve our operations. The graph on the left shows how Xstrata has increased its usage of UG2 relative to the mined ore. This has the joint effect of expanding the life of Xstrata's reserves and resources, as well as countering the effects of mining inflation on mined ore. In addition to chrome ore, access to electricity is becoming equally scarce, prompting to drive towards greater energy efficiency. In this regard, Xstrata's success in driving electricity consumption down by some 25% is clearly demonstrated in the slide on the right-hand side. The top line represents the electricity consumption of the conventional furnace technology, and the bottom line represents the same for premise. Conventional furnaces use roughly double the amount of electricity as premise. As Trevor has said, while growth and cost leadership are two important KPIs for our business, these are dwarfed when compared to our focus on safety. The graphs illustrate our unwavering commitment to continuously improve the safety of our operations. Not only are we performing well against internal and industry benchmarks, but the overall declining trend is significant. This has been achieved with a variety of safety initiatives which are best in class. We are now looking at the next level of behavioral-based safety systems and introducing industrial theatres into our operations to further improve our safety awareness and performance. Ferrochrome demand is underpinned by stainless steel production. In 2010, stainless steel production is expected to increase by 23%, representing a record production of some 31 million tons. It is largely on the back of an improvement in demand for stainless steel products. The graph shows the recovery in demand for stainless steel products, which is primarily sponsored by the recovery of the consumer durable segments, pots and pans, cutlery, domestic appliances, etc., in line with the general anticipated recovery in consumer confidence. Stainless steel demand in general is expected to grow at a healthy 6.6% up to 2015 on the back of improving demand fundamentals. China's stainless steel melt in 2010 represents some 37% of global melt production and is therefore a key market for ferrochrome. And one must mention the tremendous growth as well. In 2001, the production has been a modest 200,000. Today it's standing 37%, almost 40% of the world's 8 million tons. China domestic ferrochrome production has responded to the demand growing to an estimate 1.88 million tons in 2010, or 23% of total ferrochrome supply. Chinese domestic production is, however, constrained by chrome ore availability, and surplus demand is met with imported ferrochrome. In this regard, the market for ferrochrome imports in 2013 will be 2.5 million tons, leaving a gap of approximately 1.8 million tons as an opportunity. Once an industry with low barriers to entry, but today the ferrochrome industry finds itself supply constrained. Access to power and cheap ore are now scarce. South Africa, with some 70% of global reserves and 42% of global production, is getting deeper and moving into a 9-month industry because of the winter shutdowns as a result of winter tariffs. Short to medium-term expansions in South Africa is also questionable without captive power. Indian open cast resources are depleting and underground mining remains largely uneconomically. India is expected to be a net importer of chrome ore soon. Growth options in Kazakhstan beyond the open cast resources will be more challenging, and China should eventually adopt a more resource-efficient growth path and become increasingly reliant on imported ferrochrome. For PGMs, the picture is not too different. Being a late cycle commodity as well, a recovery in demand for platinum is underpinned by a recovery in the European auto-catalyst market. Most of the scrappage schemes in Europe have either ended or are coming to the end of the sales of vehicles, and the sales of vehicles are starting to recover. In this regard, our expectation is that global auto demand for platinum will only achieve its record level of 2007 again in 2013. In the meanwhile, an important indicator to watch is depicted by the graph in the bottom right quadrant. This demonstrates German vehicle sales breakdown in terms of engine size and fuel variant. The graph points to a recovery in the diesel market share as well as the engine size post the termination of the scrapping scheme, which are both very positive for platinum consumption. In addition to the auto-catalyst market, new off-road legislation will be a positive influence on platinum consumption. The graph on the top right-hand quadrant shows the distribution of off-road engines between Europe and the US, as well as the associated platinum demand. It is expected that some 450,000 ounces of additional platinum demand will come from this segment by 2015. On the supply side, as can be seen from this graph, the industry is well below historic levels. The challenges faced by the industry with respect to deepening ore bodies and lower ore grades is expected to continue. The industry has also been the hardest hit in terms of delays in bringing off new projects. Putting this into context, out of the many junior projects acquired by majors in the last 3 years, including Leeuwkoop, Akanani and Blue Ridge, Eland Platinum is the only operating mine with a committed growth plan. So the story for platinum is an exciting one. Legislation-driven demand, new demand segments, the dissipation of the BRICS, and a muted and delayed supply response, clearly very attractive fundamentals. The expansion of the second phase of Project Lion represents a significant boost to our organic growth profile for ferrochrome. Not only will Line 2 increase our nameplate capacity by some 20%, Line 2 will consolidate Xstrata's position in the bottom quartile of the industry's cost curve. The expansion is expected to reduce group cost of production by approximately 6%, as the new tons will be produced using the proprietary and energy-efficient premise technology. Groundbreaking of the project will commence the first quarter of 2011 and commissioning envisaged in the second quarter of 2013. The power allocation that Xstrata has received for Line 2 expansion is seen as a critical success factor. It gives Xstrata a first-mover advantage in the South African context. Project Tswelopele. It's a similar project and will add 600,000 tons per annum of sintering and pelletizing capacity to Xstrata's arsenal, and will allow us to achieve the target of UG2 consumption that we have envisaged going forward. The benefits of introducing pellets into the ore mix were clearly seen at our Bonacop operations, with improvements in both the chrome ore consumption and electricity consumption. We are confident that these improvements will be duplicated at our Rustenburg operations. The Eland underground expansions will provide a significant boost to platinum production in the group, effectively tripling current production volumes. Progress at Eland is progressing as expected and is set to reach full underground mining by 2014. Whilst moving from open cast to underground mining, the tons mined will increase and also the associated grade of ore mined, which will ultimately push production to the 313,000 kilo ounces of platinum by 2016. Pictures in this slide demonstrate progress at the Eland underground expansion. The mine is expected to be one of a full mechanized operation in the PGM sector, with a steady state run-of-mine capacity of some 500,000 tons per month. The underground declines at Eland is progressing well, with the western shaft standing at some 1,500 meters total advance, and the eastern shaft to some 1,200 total meters advanced to date. The western decline development is being undertaken by an outside contractor, which we inherited when we bought the asset, while the eastern decline is undertaken by in-house people from Xstrata. So, what do we say about future growth? In the case of chrome, as pointed out earlier, organic growth will only be secured by access to chrome ore and electricity. In the case of chrome ore, our pioneering contractual arrangements with the PGM producers and our most recent transactions with Lonmin has extended the reserves and resources of our own mines. Further projects like Tswelopele have improved our chrome consumption efficiencies. These initiatives have given us sufficient headroom to even contemplate third phase of Project Lion in the medium to longer term. And then lastly, Project Lesedi. In addition to having secured access to ore, Xstrata is also in a unique position to have optionality in terms of its own power generation, thanks to synergies with the Xstrata coal operations. In this regard, Project Lesedi contemplates a two-phased generation project to produce 300 megawatts of power in each phase, using discard coal from Xstrata coal. In addition, improving energy efficiencies and the mine-side management means that Xstrata will be able to supply over 50% of its own supply requirements outside Eskom. Our platinum growth strategy is well laid out. In 2006, we established the Mototolo joint venture with Anglo Platinum, recognizing the strength of both parties Today, Mototolo is Anglo Platinum's lowest cost producer. In 2007, we acquired Eland Platinum, developed the Opacans operation to about 250,000 tons per month, and laid out our plans to transition to one of the PGM sector's biggest and fully mechanized operations. In 2008, we moved away from the build strategy and created optionality by opportunistically acquired the 24.9% in Lonmin plc. The development of the Eland underground project, as well as the optionality inherent in our Lonmin stake, positions Xstrata to be able to deliver the necessary scale, diversity, growth, and returns. Whew, that was the wrong button. So concluding, the markets for both chrome and PGMs are leveraged to a late cycle recovery which are showing positive signs. Our focus as a business has shifted to projects delivery, and in this regard, Project Lion represents a clear first mover advantage in the ferrochrome industry and will consolidate Xstrata's position in the bottom quartile of the industry's cost curve. Eland is on track to deliver its 313,000 ounces of platinum steady state. Resource efficiency is a key theme to our cost leadership strategy. In this regard, we have set ourselves apart from our competitors with industry-leading energy efficiencies and an environment of escalating electricity costs in South Africa and globally. Similarly, our improvements in chrome ore efficiency and increased UG2 contracts has extended the lives of our own mines. Lastly, our future growth is secured through captive power generation initiatives and chrome ore resources in excess of 30 years. Thank you.
Morning, it's Liam Fitzpatrick from Credit Suisse. Just two questions on the ferrochrome market. Obviously, China is having a much bigger impact on this market now, so can you give us your view of where you think the marginal cost of production in China is? And secondly, on chrome ore exports out of South Africa, do you think there's any prospect near term that they're going to raise export tariffs on that?
Well, the first one, the cost in China is clearly the highest cost in the cost curve, fortunately. So second to Xstrata's output, China's output is the biggest. So they are today the second biggest producer of ferrochrome. And that is a comfortable position to be in because that forms a tremendous umbrella for the South African producers due to the cost structure. It's been produced a lot of small operations with a lot of pollution and a lot of restrictions. I mean, it's not sustainable. I think that is the best thing to say. So in the longer term, they will either have to also install proper capacity, but then they are totally reliant on chrome ore imports, which cannot be in a nice position to be in. And as you've seen from the numbers, it is not small numbers that they require. It is really very, very big numbers that they're talking about. As far as chrome ore exports and maybe a duty is concerned, we do our utmost in engaging with the government to demonstrate to them the tremendous infrastructure that has been installed in South Africa in terms of rails, harbors, export facilities, all the mines and all the operations that will be at risk if the chrome ore from South Africa has just been exported and it's getting cheaper and cheaper and China can produce then ferrochrome on a cheaper basis. So I think it is obvious whether it will come and whether it will come soon, that time will tell, but I think it's on the table. It's imminent, I think.
It's Grant Sporer from Deutsche Bank. Just a question on your thoughts on how the South African situation in terms of mining licenses is evolving. Just last week we had the news that one of the licenses from Inco Platinum are possibly being revoked. So how do you look upon that situation?
I can't put it different than to say I don't think there's many people in this room that can still remember Barney Bernardo and Cecil John Rhodes, etc., etc. But I think the situation in South Africa is very, very similar. There's a once-off opportunity. Suddenly there's reserves and resources available from the majors, and everyone who now wants to be a new mining entrepreneur and from the previous disadvantaged group together, and everybody goes for everything that is available, and some of the people have got very good contacts, they believe, with the president, or they believe with the minister, or etc. So we knew from the beginning that there will be a lot of challenges on the inquest claim that they've got the reserves. And I mean, they've been confident because they had the documentation from the minister. And it went through the normal court, and they kept the reserves, and then went to the High Court, they still kept the reserves, and then it went to the Constitutional Court, and they lost it. I think there's going to be, on this new available reserves and resources, still many similar things to happen. From our side, we've got an open mind. I mean, as far as we are concerned with Inque, the day they come with a bankable feasibility study, which they funded themselves, and if the bankable feasibility study has got an hurdle rate that we've specified above that, we've got the option to continue the project, otherwise not.
Ephraim Ravi from Morgan Stanley. Two questions. First, could you give us a sense as to the cost of power generation, your weighted average cost of power, assuming the 35% increases in power cost goes through, including Lesedi, after, in terms of your effective cost of power, somewhere around 2017, given the change in mix in terms of bought-in power versus generated power, and how would that put you in the cost curve versus your South African peers in terms of your difference versus Samancor, for example, your guesstimate in terms of how much cost advantage you would be versus your main competitor there?
I do not think Project Lesedi will necessarily give us that huge cost advantage. The huge cost advantage we've got is through the premise operation, where we roughly use, say, 2.2 megawatt hours per ton, where the conventional processes are doing 3.8, 4 megawatt hour per ton. So that is the big saving. I think Lesedi is more a matter of, we've got the coal, we've got the process, we can secure the supply of electricity of up to 60% of our requirement, and the cost increase will be in our control. I think that will be the advantage.
And the coal for Lesedi would be transferred from your coal division at an ESCOM-like contract? Would that be the way to think about it?
Yes, of course. The coal operation have got outside shareholders, and the alloys operation have got outside shareholders, and it must be an arm's length deal between Xstrata Coal and Xstrata Alloys.
Thank you.
Thank you very much for coming today and giving me the opportunity to talk about Xstrata Coal, and today Xstrata Coal and Iron Ore. With having this year fully commissioned the Gurkefontein project, having commissioned the Blakefield South Underground, having fully converted the Liddell open cast operation in New South Wales from a contract operation to a full owner-operator operation, having made significant progress with the Atcom East project that we're currently undertaking, having made huge progress with the Mangula operation, and you'll be hearing about all of these later, the Mangula opencast and beneficiation plant project in New South Wales, having had approval in August for the new Ulan West underground mine adjacent to the existing Ulan operation, and today announcing the Ravensworth North large, high-quality, low-cost operation in New South Wales. I think it's fair enough to call our presentation Growth on Track. I'll be talking, and I'm doing a bit of delegating today, I'll be talking about the coal business in general, just giving a bit of background as to how we developed it and how we operate it and how we run it. But a lot of what we do in the coal business is predicated on a view on the market. And time and time again, I guess we've been standing up here talking about our confidence and our belief in the strength of both the thermal and the coking coal markets. It underpins what we do in terms of our development thinking, and it underpins what we do in terms of growth. Trevor gave you a good insight earlier on into the fact that this work takes several years. These projects don't happen overnight. And this development pipeline that you'll be hearing about today is something that we've been working on for a long time and continue to populate with more opportunities. But it is underpinned by our view on the market. And today I have Andrew Fickers here with us from our marketing team, who will talk to you about our continued strong and confident view of that market. Jeff Gerard is joining us as well. He'll take over from Andrew. He'll talk about our organic growth pipeline, where the projects are, what we're planning to do, and then I'll conclude and then hand over to Mark Eames, who has just taken on the role of Chief Operating Officer of the iron ore business. Iron ore currently falls within coal. It is a young and nascent business for us. We've decided that we will incubate it within the coal business, and there's a lot of logic to that. It leverages off our bulk mining experience and capability. We build and run very large processing facilities. We have, I would say, industry-leading expertise when it comes to logistics, be it rail or port. And most of all, and what you'll see today, is we have, I think, tremendous capability in taking projects through pipelines right from the concept level through to ultimate delivery. So given the positions that we've now acquired within iron ore, it makes sense, while it's still fairly small, that it is incubated and leverages off those capabilities within coal. That's what we won't see, longwall shearing. I think most of you are familiar with our business. It is the leading thermal exporting coal business in the world that generates high margins, and essentially, in summary, we have a very strong position within Australia, producing both coking coals and export thermal coals and a small amount of domestic coal. And that you will see when you look at our pipeline today, that business there is very well positioned. We've been able to develop resources in the area beyond what was thought to be there when we initially acquired the businesses, or certainly by the previous owners. And we're very well positioned there to meet the very exciting growth that we're seeing, particularly in the Chinese and the Indian markets and the Pacific market. We have a very significant business, obviously, in South Africa there, with a very significant proportion of export coal. More than 50% of the coal that we produce there goes to export. We double wash all the coal we produce, so there's a domestic fraction as well there, which tends to generally go to domestic thermal generation, or Eskom. More and more, and you'll see coming out in the marketing discussion, where South Africa used to principally supply its export coals into the Atlantic market, into Europe. The massive demand that we've seen in the Pacific market has pulled that coal largely, and the majority of that coal today mostly that export coal goes into the Asian market. And that includes destinations such as India, Malaysia, and even China. That in itself has helped balance our markets. Obviously, we're seeing this three-speed economy globally, and we have seen a slightly weaker Atlantic market coming out of the global recession, but that pull of coal into the Pacific out of South Africa has enabled that market to again tighten up, which means that our low-cost operation in Cerrejón, our interest in the Cerrejón joint venture, is well positioned to also grow and also take advantage of what we believe will be a firming Atlantic market again in the future. As I said, we are a leader in the thermal seaborne in the world, and with the projects that you'll see today, we expect, all things being equal, that we will maintain that position. Our main competitors in this particular seaborne market, traded thermal coal market, either producing a much lower quality coal than what we do, don't have the same opportunity or project pipeline that we do, or operate at higher margin, or not higher margins, higher costs and lower margins than what we do. We also have a very significant position within the metallurgical coal markets. It's a very important part of our business and a very high margin part of our business, and we continuously look at opportunities where we can grow that. Now, you will see today that most of our growth is organic, brownfield type opportunities, and the new paradigm that we find ourselves in terms of coking coal prices and the market has allowed us to re-examine our coking coal businesses as they stand today. For example, Oakey Creek, where we are in the process of looking at concept phase, some open pit opportunities. The new pricing paradigm we find ourselves in makes some of the resources around those types of properties very, very interesting. And in fact, we will be starting a small open pit operation towards the end of 2011 at Oakey Creek as a potential run-up to something larger in the future. But it all starts with resources, and we've seen that we've been able to grow our resource base very significantly over the last years. Some of it through acquisitions, some of it through development work. We invest very heavily into understanding the resources around the operations that we own, and that has allowed us to develop opportunities that previously weren't seen. For us and for me, seeing this graph picking up here is really a precursor to what comes next, and that is the project development. You will see today a number of projects, and again Ravensworth North is an example of it, where we've been able to increase the resource base in New South Wales and then ultimately turn that into a business opportunity. The Ravensworth North opportunity has come about by combining several leases which previously were considered either on the surface as a low value, small open pit opportunity, or a difficult underground mine at some depth. By reviewing these resources, understanding the geology in toto, we've been able to develop a very significant open pit mine there, which you will hear about later when Jeff goes through the details. But it is about developing the resources and understanding where they are and taking that forward. Similarly, in Queensland, we've seen some tremendous growth in our resource base there. This is around all of our operations, but to a large degree driven by the Wandone project, which we will discuss. We all know the Wandone project, which we're talking about taking forward in the next 12 to 18 months, is a very, very significant development, potentially running at 30 million tonnes run of mine, producing over 20 million tonnes of product, although requiring rail and port infrastructure to get that going, but ultimately having growth potential beyond that. South Africa, we continuously changing our operations from underground to open pit, again through the fact that we've looked at the resources in a different way. And similarly in the Americas, we see some potential for growing our Cerrejón business there as well. So Xstrata Coal does have a track record of value creation. We have found ourselves in a situation where coal prices have sustained themselves even through this recession that we saw recently, where coal prices have essentially maintained themselves above the 90th percentile producer. And that's as a result of it being the right fuel at the right time and ongoing supply shortages. This in itself has attracted more high-cost producers into the game, pushing up the ultimate end of that cost curve and enabling us to have continued strong margins. Now, you will see today that our position on the cost curve we've actually moved from first quartile just into the second quartile, and that's a function of the domestic currencies that we operate in. We're dealing with an Australian dollar that's almost at parity and an incredibly strong South African rand in particular. However, our margins have been sustained, and that is a result of the changing dynamic of that cost curve, plus the fact that we are continuously trying and bringing on more operations that will try and push us further down that cost curve. I would like to talk today about some of our successes in acquisitions and how we've turned businesses around, how we're delivering projects, a number of projects, as I mentioned earlier, on time and on budget. I would like to talk a bit about our operating excellence that has been mentioned by Trevor earlier on, and the fact that once we acquire or once we build a mine, that we can achieve exceptional outputs from those. But all of that has to also be done in terms of having and maintaining leadership in the area of sustainable development. Just looking at some of the acquisitions made over the last few years, Bulga Beltana, essentially there was what we call the Southern Underground, which was winding down in 2001 when we acquired that business. We looked at the opportunity, where do we go with that underground, and we developed the Beltana underground operation, which was popped in off an old high wall that we saw there. Hadn't really been developed by the previous owners or thought about that well, and ended up becoming Australia's #1 producing underground for a number of years, and it's now phasing out as we move into the Blakefield, South Blakefield operation, and as we build up production there, we see that it too has a potential of being one of the leading longwalls within Australia. When we acquired Mount Isa Mines, their coal business, there were 3 underground operations, the 2 at Oakey Creek, 1 at Newlands, and we had to redeploy the Newlands underground because it essentially was also in an area that had been exhausted, and was successful in putting an underground at Newlands that it too ended up being a top producer, and you'll see a graph later on within Australia, producing record tonnages. Oakey #1 and #2, the first things that we experienced were risks of ignitions on the face, so we had to slow down that mine. We also encountered on day 1 of operating Oakey North very serious ground falls and roof conditions. However, through our underground capability and the excellent teams that we have, we've been able to turn those mines around, where Oakey now is sitting at the top of the graph in terms of Australian production rates. So a tremendous success record in the underground mines, with the continuing challenges that we do have with ground conditions. They are tough mining conditions throughout. However, I believe that generally the teams and the planning and the engineering we put into it allows us to compensate for those ground conditions and remain leaders in the field. We developed the Ralston mine since we acquired MIM. Today it is probably the most efficient open pit mine in Australia in terms of productivity measures that we apply, and essentially runs at world best practice. And you're all aware that about 2 years ago we acquired Resource Pacific. Essentially wasn't operating or capable of operating when we acquired it, and today is a very consistent producer, producing a very high quality semi-soft coking coal. Project delivery, well, we've spoken about projects, a number of projects. We've essentially run 8 projects so far in coal, delivering around 30 million tonnes per annum. We've got 6 more projects right now in implementation that will add a further 30 million tonnes per annum, and I think the graph speaks for itself in terms of the type of growth that we're delivering compared to our competitors. From an operational excellence point of view, we produce about 40% of Australia's underground longwall coal comes from our operations. The red bars are Xstrata operations. The one on the wrong side of the graph is an operation that closes in a few months' time and it's run out of reserves. The The other operations are being worked on in terms of pushing them further up the curve. In particular, Ulan, we've had some tremendous successes there, although some difficult ground conditions. Oki 1, remember, we shut that down, so essentially we have a new team there. So both those operations should and have the capability of moving up the curve. But you can see the sorts of leads we're getting on the rest of the industry in terms of Oki North and the Northern Underground in terms of performance capability. And that expertise and knowledge that has allowed us to do that is being applied to the other operations. Ralston, in a very short time, we've managed to increase year on year the production rate by around 34%, and other than some spectacularly unusual weather this year, that growth would have continued. However, we have there identified resources that will allow us to further expand that mine. Those operations and the expertise we have there is being applied to all of our other 12 draglines that we have in our business and the 43 excavators that we operate around the world. But none of this can be done unless we do it responsibly and we consider the sustainable development aspects. I think you all know, but it's always worth saying that Xstrata has 4 years running been selected as the sector leader in terms of sustainability by the Dow Jones Sustainability Index. This is as a result of both excellent practices, transparency, and excellence in the way that we report it. Our environmental excellence stands out. We're very focused on reducing dust and water issues that are of grave concerns to the communities around us, to the point where we are recognized for our best practices. We are seen today as leaders in the area of climate change and have received awards for our rehabilitation practices. But what I'm particularly proud of is what we've achieved in our communities in terms of making sure that they benefit too from our presence. Safety is something that comes first in our business. We continuously work on improving it. This year alone, we are reducing our total recordable injury frequency rate by in the order of 27% so far this year on a year-on-year basis, which happens only through an amount of tremendous effort from the management teams. So a quick snapshot of where the business is. I'm going to now hand over to Andrew Fickers so he can talk to you about the markets. Thank you.
Thank you, Peter. During this presentation last year, we presented a view that the markets were going to grow very strongly as we entered into 2010 and to continue to grow strongly through the balance of 2010. – 2010 has in fact delivered substantive thermal coal demand growth, and on latest data looks like growing at a total of 60 million tonnes. This follows an increase of 39 million tonnes of demand growth during 2009. Cumulatively, the seaborne demand growth has now sustained itself at 10% per annum. The lull that we experienced during the recession has been put behind us. The demand is being driven by developed economies and the developing economies and the industrialisation. In Asia, coal remains the lowest cost fuel source, and we've seen 8 gigawatts of new capacity being installed in the last 2 years. In a rapidly growing market, with demand projected to increase more than 500 million tonnes over the next 10 years, competition for energy supply continues to intensify, and diversification remains a real long-term consideration. The supply shortfalls characteristic in the lead-up to the recession have not been apparent during 2009 and 10, but they are emerging. Capital investment in infrastructure capacity has facilitated new supply growth that was committed prior to the recession. However, the rapid demand growth is exposing supply shortfalls, and in particular in the high energy coal spectrum. Indonesian supply has continued to grow rapidly, but all of the new supply is in the subbituminous or lignite category. Bituminous coal supply from Indonesia, by our estimate, has declined 25 million tonnes over the past 2 years. By the very nature of our industry, committed project developments lag long-term demand. However, resource depletion at existing operations requires that investment in new production capacity exceeds demand growth. And in our view, that is in the order of 100 million tonnes. While resources and projects exist to meet that demand, much of this new supply requires significant new investment in rail and port capacity, and any delay to that investment of the uncommitted supply capacity will ultimately expose supply shortfalls. Chinese and Indian seaborne thermal coal demand has increased exponentially, tenfold since 2002, and exceeding most forecaster expectations. In the most recent 5-year plan, the Chinese government has signalled consideration to cap domestic coal production. Production in 2010 is currently in excess of 3.2 billion tonnes per annum, and a cap at 3.8 billion tonnes per annum would expose the Chinese economy, basis the IEA's current policy scenario, to an 800 million tonnes of coal equivalent supply shortfall in the medium term. Chinese coal production, its coal production base, has continued to shift to the north and to the west, with Inner Mongolia and Shaanxi now dominating. While the production base has moved, the demand centres have remained coastal, and this divergence continues to expose supply shortfalls. Additionally, the greater transportation distances, combined with the declining coal quality, continue to add significant cost increases and increases the competitiveness of seaborne trade. Indian import thermal coal demand continues to accelerate and have a marked impact on seaborne trade, as Peter mentioned earlier. In addition to the ultra-mega power projects under construction, there are many near-coast power stations developments being operated and developed by private conglomerates and constructed with the intention of importing coal. Recently, Reliance announced that they had signed a deal for the delivery of 30 gigawatts of new coal-fired capacity from the Chinese, and that followed an announcement last year by Adani, who had signed a similar commitment for 8 gigawatts. Combined, that new capacity would represent 120 million tonnes of additional Indian coal demand. With thermal demand having risen in excess of 90 million tonnes during the past 2 years, it is no surprise to see a significant price response. High-cost supply, primarily from Russia, is required to meet demand and underpins market pricing. 12 months ago, we said those prices would rise, and since December 2009, prices from Australia, Colombia and South Africa have risen collectively by more than 30%. Atlantic coal markets are integrated to the broader energy complex. The traded coal market in the Atlantic Basin has surpassed 2 billion tonnes per annum and is more than 10 times the physical market. Coal trade is linked with the energy complex. It's linked with electricity, it's linked with gas, it's linked with CO2 and with the freight markets. The market arbitrage, as measured by the dark spread, drives trading activity and coal pricing. The rise of gas prices in Europe during 2010, driven by economic recovery and gas price renegotiation, has seen coal shift to the lowest cost alternate fuel supply source, especially for the winter period that we're currently in at the moment. Forward gas markets remain in strong contango and provide strong pricing signal for the coal markets going forward. In the Pacific market, 500 to 600 million tonnes of Chinese coastal trade and consumption is integral to the market pricing. Chinese domestic prices did not fall to the same extent during the recession as they did in the international markets. The Chinese domestic cost structure continues to be impacted by imposition of taxes, increased labour costs and safety compliance. Chinese coastal consumers increasingly in the southern provinces, they have the import capacity, they're taking coal from the northern sectors, and they're somewhat indifferent to taking coal, be it from domestic supply sources or the international market. Rising domestic prices in China due to supply shortfalls generates the arbitrage and import demand stimulus. Switching now to metallurgical coal or coking coal, we can see there's been a marked shift in the rate of growth between what has happened historically and what's projected going forward. The accelerated demand is being driven by steel demand growth in China, India, Korea, Taiwan and Brazil. A key factor for this demand growth is economies of scale. This has driven investment in larger, more productive blast furnace capacity, which requires high-quality coke and coking coal inputs to ensure operational stability. This has shifted demand to seaborne markets in order to supplement lower domestic quality coals. From a supply perspective, there remains a very high dependence on Australia and Canada as a source for prime hard coking coal. During 2010, supply from the US has bridged the gap, but the US export capacity is almost fully utilised and additional supply growth is restricted by their infrastructure. New projects in the coking coal space have been committed. However, in some cases, we view that the infrastructure is lagging the investment in the operations, and we expect delays to that supply and subsequent price responses. As in thermal coal markets, we've seen Chinese and Indian demand massively increase over the past 5 to 8 years. These two nations, the world's most populous nations, continue to enjoy rapid economic growth, which has resulted in a structural shift from rural to urban living and the establishment of supporting infrastructure and services. Steel and steel products remain fundamental building blocks. In India, continued investment by state and private companies will see blast furnace steel production capacity increase 70% by 2013. Indian domestic coking coal production capacity has remained below 7 million tonnes since the mid-90s, and Indian steel makers are fundamentally reliant on import capacity. Chinese coking coal imports surged during 2009 as the Shaanxi mines consolidation was enforced and small-scale blast furnace capacity was shuttered. The construction of larger blast furnaces in China necessitates higher coke and coking coal quality to operate efficiently, and imports are and will continue to supplement the domestic coal. Since the recession, hard coking coal prices have risen strongly, driven by that strong demand growth and supported by steel price increases. Hard coking coal contract prices have now risen $120 since December of last year, with the most recent announcement of the JFY Q4 settlement at $225. During 2010, Xstrata has continued to secure contract premiums, having sold annual contracts at up to $270 as announced during Q1 of this year. And additionally, Xstrata has been very active in spot markets, having recognised that the markets would recover, and by withholding tonnes from that contract market, we've secured that spot market premium. To summarise then, thermal and coking coal demand outlook is underpinned by the energy complex integration and developing economy growth. Development of new supply to both replace depleting operations and meet demand will expose supply shortfalls in the near to medium term. Fuel market prices remain strong, reflecting the energy complex integration and the high marginal cost of supply. With that, I'll hand over to Jeff, who can follow with our project pipeline.
Thanks, Andrew. So my name's Jeff Gerard. I head the M&A, resource development planning and the project pipeline for Xstrata Coal. And I guess following from Andrew's presentation and the strength we see in the market is the reason that our development pipeline is such an important part to the business. I guess we were here last year talking about our pipeline. We'd spent a significant amount of time putting together our processes and systems leading up to that. I think from today, what you'll see is that we've taken the next step with our project pipeline in terms of resourcing the plan, putting more people into the business to deliver those plans, but also to look at how we deliver the projects and ensure that that delivery is about being on budget and on time. So the project pipeline, as you'll see, is made up of basically 17 projects at this stage. There are others as well, but it's basically spread between three phases. As Peter mentioned, a number in implementation, a number in feasibility, but we also have a large number of projects in the pre-feas and concept level to continue to supply this pipeline. If you look at that is our pipeline. We've delivered a number of projects since we were last here. It's basically a well-balanced project pipeline. 8 delivered, 6 in implementation, and a further 9 in planning and feasibility. I mentioned before that we've been looking at resourcing. We're now in the coal business to deliver that project pipeline. Have over 600 people involved in project management. In line with the way in which we've run our business, which is giving people the personal responsibility, the accountability, applying governance structures, applying processes, we've been able to ensure that pipeline that we're currently planning is going to be delivered on budget and on time. I'll go through some of the individual projects just to give you a flavour of what we've done. Peter mentioned both Blakefield South, which is an underground mine, new development in the Hunter Valley. This was the continuation of longwall mining at Bulga, following from the Beltana longwall operation. It's a first quartile cost base, and it provides 100% export coal. At the same time, in 2008 and 9 into this year, we built a greenfield project called Hukkafonden in South Africa. And you'll see that both of these projects are first quartile cost base. They're helping us bring our cost base down. They're fundamentally less than $100 per tonne. The capital construction cost is less than $100 a tonne of the project, and they've been delivered and are now operational. I guess the other projects that we have in implementation, three projects I just thought I'd give you an update on. The Atcombe East project in South Africa, which is an open cut project, will be operational in Q1 of next year, so it's almost there. It's from the time it was approved, we've been able to deliver that project in about 18 months. And the reason for that short delivery is because it is a brownfield project, and we have been able to leverage off existing people, existing operations and existing infrastructure. The Mangoola project in New South Wales has taken a little longer to deliver. It's been a 3-year delivery. It's a greenfield project requiring the construction of rail, all of the facilities on site, and it will be a large open cut operation with a first quartile operating cost. And at this point in time is actually ahead of budget in terms of it's coming in less than we budgeted for, and it's coming in ahead of time. And we'll see that by the middle of next year. Ulan West was a project approved earlier this year, a large underground mine. Again, it's a brownfield project because it's part of the Ulan complex. We already have an underground mine on that facility, and this is putting in a second underground longwall operation within the same resource area. Typically, underground mines take a little longer to deliver. This is 2 years to get the development happening, and 4 years to see the first longwall coal. But again, it's a pretty exciting project in an area that we already operate in. And I guess one of the things that is important to note with a lot of these projects is that we already interact with the stakeholders in that area. We already interact with the community. So we're able to deliver these projects within existing location, which allows us to deliver them a little faster. Peter mentioned, and Ravensworth North has been announced this morning as approved. It's a large open cut project. A little bit hard to see on that thing, but I guess the thing I wanted to point out here is that, and I think this works, this is again in an area that we currently operate. And what we've been able to do, I guess, is that we've been able to leverage from our existing businesses. The missing link in this whole, maybe just to describe where we are, Mount Owen, Glendell, all of these mines that you see in that area are the mines that we've acquired progressively since about 1996, 97. We've been able to pull them together and leverage off the different mines to utilise the infrastructure, to find synergies that, as Peter mentioned, individual owners could not see. By accumulating this list of resources, we've been able to develop mines that no one previously saw. I guess the last one that we bought was the Ravensworth underground operations, which for this Ravensworth North open cut was a key. It was a key underground producing mine for semi-soft, but it was also a key for infrastructure access. So Ravensworth North has been a combination of resources from Cumnock, resources from Ravensworth West mine, equipment coming from Narama, infrastructure from the Ravensworth underground, to pull this together into a project that is going to provides a greater than 20% internal rate of return. It's a large open cut, and it will be constructed and be producing within 2 years. Last year we talked a little bit about Wandoan. The Wandoan is the large area in the Surat Basin of Queensland. By way of update, I guess, we've had the government approval for our EIS, happened in November. We're continuing to work with the government on mining lease conditions. We've submitted further applications over this area. You might recall that this area is basically 100 kilometres by 100 kilometres, so it's quite a large basin. Our exploration has continued. We've upgraded our resources by a further 1.1 billion tonnes. And we've been working with the government and on infrastructure, both at Surat Basin Rail, which is a new railway line that will need to be built to link to the existing ports at Gladstone. We're a participant in stage 1 of the Wiggins Island facility. We've qualified for the Wiggins Island stage 2 and stage 3. We've been working on other port opportunities, which is Balaclava Island. So the project continues to move forward, and we'll be looking at bringing some of the planning phases of this project for approval during 2011. So all in all, what does this mean? I guess our project pipeline, we're looking at delivering growth of 10% per annum. The majority of our projects happen to be or are brownfield projects. They're able to leverage off our existing business. They're able to be brought on quite rapidly, and they're within an area where we currently work, as I said, with our communities and our stakeholders. So it's quite an exciting time, and I guess with our view of the market, as Andrew expressed, and our ability to deliver these projects and the number of projects we have, we're quite positive to continue to grow in the areas that we've talked about. So with that, I'll hand back to Peter. Thank you very much.
I think a lot has been said, really, and I'll try and keep this brief. We, I believe, remain the leader in terms of thermal exports and intend to maintain that position through this excellent pipeline that we have. And the assets you've seen today that we're talking about are truly high-quality assets, which are on top of those assets that we acquired that we turned from perhaps not being so high quality to Tier 1 opportunities. We are continuously working on our position on the cost curve and battling the headwinds of domestic currencies. However, these projects are generally highly efficient, as low a cost as they can be. Within the regions they're highly competitive, and we will continue to keep pushing our position down that cost curve. We do have a track record of value creation. I think in our presentation on marketing today, you'll have seen that we have a fairly good understanding of the market that we play in, and that's allowed us to make these decisions on how we take our business forward in confidence. We have, with the 28 billion tonnes of resources we spoke about, we have, I think, an unmatched set of opportunities for taking our business forward, and we've risen to meet that challenge as we continuously look for more opportunities. So, as I said earlier on, as I introduced it, I believe our growth is on track. The question now is, where do the tracks come from? So we need a bit of an iron ore business, and I'll introduce Mark Eames to you. I worked with Mark in Hamersley Iron many years ago, where he led business development for a number of years in Hamersley Iron for Rio Tinto. And more recently, he worked with us in Xstrata Coal, first in business development and then marketing, and he's now taken on the role of Chief Operating Officer, Iron Ore. Thanks, Mark.
Thanks very much, Peter. Today is something of a milestone for us. The recent acquisition of Sphere Minerals, combined with Xstrata's existing option over a large iron ore resource in the Republic of Congo, heralds an exciting new chapter for Xstrata, in particular our entry into the iron ore industry. Iron ore is a particularly attractive commodity to us because it is exposed to the unprecedented development of infrastructure that has been highlighted in a number of the presentations to date. We believe that this industrialisation phase will drive prolonged volume growth for iron ore and underpin attractive fundamentals for the product. Our entry into this product has been measured and effective. We've secured world-class resources with valuable optionality at an attractive price. We now have options over 7 billion tonnes of resource with an attractive pipeline of projects and a range of potential products. Combined with our proven skills in mining, bulk logistics and projects, we now have the opportunity to create a world-class business. So turning to the iron ore market, we believe that seaborne iron ore volumes will grow at over 5% each year, driven by continuing demand for steel as economic development leads to urbanisation and industrialisation on a global scale. Of course, we expect existing iron ore suppliers to respond by increasing supply, but resource project and regional challenges will necessarily blunt this response. Hence, we see the opportunity for a meaningful entry into this attractive product. Turning to the specific options, on the 11th of November, we announced that Xstrata acquired more than 50% of the shares in Sphere. Our interest since then has continued to grow and now stands at 75%. The Sphere acquisition brings us 3 organic growth projects in Mauritania, West Africa, together with an experienced and successful development team. Mauritania is already a significant iron ore producer through its national champion SNIM. In fact, the country has a longer continuous record of iron ore exports than Australia, since the first shipment left the country in 1963. We have 3 projects: the flagship El Aoudj project in partnership with SNIM, the ASCAF project, which offers the opportunity for near-term production, and the Lebthenia project, a very large magnetite resource. Together, these projects contain resources on a 100% basis of almost 4 billion tonnes, mostly already in the measured and indicated category. The combination of our partnership with SNIM, Mauritania's natural advantages as an iron ore producer, these resources, and Xstrata's capabilities is genuinely exciting. In the Republic of Congo, otherwise known as Congo-Brazzaville, Xstrata has been funding an aggressive program of exploration and studies, and we're pleased that the pre-feasibility study for a large iron ore resource in that country is nearing completion. At the conclusion of these studies, Xstrata has the option to take a controlling interest in this large resource, and over time we have a defined pathway to get to 100% ownership if we so choose. What attracts us to this project is its potential scale, a 3.3 billion tonne resource already delineated and with significant infrastructure, relatively easy infrastructure potential, with a relatively short rail route identified to one of the best port sites in West Africa. To add to this interest, the mineralisation supports a range of products, including a conventional hematite sinter fines product. One last point we'd like to leave you with is that we just wanted to highlight the evidence that shows that we have in fact been measured and effective in bringing this upside to Xstrata shareholders. If we compare our entry price for these options with comparable trading multiples or transaction multiples, and I'll encourage you to check these figures for yourselves, you can see that we've obtained world-class optionality at a measured cost. Thanks very much indeed.
The microphone's over there. Any Q&A? Thank you, Mark.
Michael Bogish from Macquarie. First question, Peter, on coal. In terms of future production and offtake, is there any preference or is there going to be a greater split that's going to be priced on spot terms? And second question on iron ore and ASCAF. What is the current status of allocation for rail and port, and especially in the context of scalability? Thanks.
All right, just on the coal, the tendency is towards more spot, I believe. Certainly with the emergence of China and India as buyers, that tends to be more on a spot basis. And the large traditional long-term or annual contract buyers, their tonnages are not increasing as fast. Plus the changes that we've seen certainly in the metallurgical, the coking coal markets, which has gone from annual benchmark style pricing, not that we necessarily followed that, through to quarterly, and now the discussions around monthly pricing. So these markets are trending towards a spot level. As far as the quotas on rail and access to rail and scalability, we believe that both rail and port are quite expandable, and there are still ongoing discussions with SNIM in terms of how that works.
Hi there, Olivia Kerr from UBS. Couple of quick questions. I was interested in the change in performance on costs. Can you kind of give us a bit of an idea just how costs are tracking this year? And also, if it's a currency issue, have there been other Australian producers that have kind of moved as well?
Our costs are tracking year on year. We have demonstrated and have always delivered real cost reductions. And the phenomenon you saw there really was an exchange rate related phenomenon. Those are US dollar delivered prices. So the real issue that's happened there is that you've had Indonesian coal come down into the first quartile. So we compare well against our competitors in all the geographies, and we continue to reduce our costs in real terms.
Okay, and just a second question. In terms of China's domestic production base, how long are you sort of expecting until they start to deliver this sort of infrastructure that they're promising to actually sort of start to really get the domestic production up and running?
There are conflicting messages about whether or not that infrastructure development is in fact going to deliver huge amounts of coal that will move them from being a net, the rumours have been going around that they will move from being a net importer to a net exporter again. The disincentives that the government puts on exports there will, I believe, continue to be ramped up to disincentivize that. There's too much need domestically, number one. Number two, the move that we're seeing by the Chinese in terms of their interest in resources outside of China would suggest that that they internally see a resource issue and an ability to meet their own demand. Thirdly, we have actually seen discussions on, or heard of discussions where they're in fact going to cap production. So the overwhelming evidence for us and the track record over the last 10 years suggests that the imports are going to continue to grow. And every estimate we get, and we tend to be bullish, generally gets surpassed. They import more than what we expected.
Hi, it's Stephen Clapham from Altima Partners. Can I ask you two questions? Firstly, in Australia, Queensland Rail, can you talk a little bit about the relationship with them and how you foresee that might change now that the company's been privatised? I'm thinking particularly, do you see them becoming more efficient, and do you see them taking a greater share of the economic rent, as we've seen, for example, with US rail operators in the Powder River Basin? And secondly, just following up on China, I was quite interested in your comments. A 3.8 billion tonne cap would mean an 800 million tonne shortfall. I wonder if you could just give us a bit more colour about the time scale that you're talking about here, and what do you foresee in terms of imports from Mongolia?
First question on Queensland Rail. I think everybody's aware that the industry was quite interested in acquiring the asset, in particular the track. historically, the infrastructure system has underperformed. The reality is that there's no shortage of port capacity in Queensland. Hence, the only bottleneck has been track and trains. So the performance of Queensland Rail in Queensland has been problematic, has slowed the development of the industry, and has resulted in these phenomenal queues that you're seeing sitting off the ports. It has now gone through the privatisation process. We are very keen to see that the management, which is the same management that was there before, actually now turn this business around. And I guess time will tell whether or not they can. In the interim, you are seeing on the above rail side the emergence of new providers. For example, this year we launched our own in New South Wales, Xstrata Rail, and are building up our own rail capacity at a rapid rate. We'll be commissioning the first 12 million tonnes of capacity early in the new year, and we intend to grow that quite rapidly. You'd also be aware that the track gauges are different in Queensland and New South Wales. So for us, any growth in Queensland, we would seriously consider utilising Xstrata Rail for. In terms of extracting a disproportionate rent, the regulatory system in Australia and hopefully the Queensland government and the federal government realise that the value to Australia is in extracting the resources and not having a super rich rail company, and will regulate it accordingly. However, I do believe that there will be opportunities as new rail, unless the development is done on time and at a sensible price, any new major rail developments within Queensland and all of these new basins that are coming in and being spoken about, Wandone in particular, may not end up being done by Queensland Rail, but may be done by some other parties. So the challenge is up to them, A, to deliver on the infrastructure and systems they've got now, and B, to do it cost effectively so that they can continue to deliver the growth that they've promised. And I'm trying to remember what the last question was. China on the 800. I think the key message is that there's conflicting information. The reality is that their growth will continue, and that growth requires energy. Some of it will be met domestically, and I believe a lot of it will be met with imported coals. So I'm not going to give you a year on the 800 million tonne shortfall, but should they decide to put that policy in, there will be a shortfall of coal.
Well, if there's an 800 million tonne shortfall, that's going to be quite a problem for everybody, isn't it?
A problem for some and a boon for others, I guess. Yeah.
John Tomazos, Very Independent Research, U.S. In your coal market planning for China, how much do you estimate their wind and solar installations will be, or what percent of the electricity will they generate? China's begun keeping track of their energy use and their CO2 emissions.
Correct.
They appear to have blown through their 2020 quote already.
They've made tremendous progress, and we obviously monitor all of the plans that are publicised, and we've seen that, and certainly in the last year, 50% of global installation of wind power actually has been in China, and we think that's appropriate. And in the same vein, they are developing amongst the most efficient boiler technologies for the utilisation of coal with ultra-supercritical technology that they use. But we do monitor the percentages, we do watch the planning that they're doing, and even within that we continue to see coal grow. I don't know if you know what the percentage is, Andrew.
No, I can't quote specific percentages, but I guess suffice to say that even if they were to continue to grow at the current rate, it has very, very limited effect on coal consumption. It's starting from such a low base, and the absolute demand is so great that it can't have a material impact.
Interesting from the numbers you saw there, if you look carefully at the graphs, India is as important, if not more important, in terms of the future Pacific or Asian coal dynamic as China is. and the fact that you saw today the 38 gigawatts of imports of stations, the 30 has been targeted to be delivered over a 3-year period. Now, whether that will be achieved or not, I'm not sure, but it shows very, very aggressive growth ambitions.
Peter, it's Crystal Femina from Barclays. Just a question about capital allocation, how you think about that in the business. So if we look at your coal business now, you have tremendous growth potential in thermal coal still. Coking coal, really not so much. Even though it's a market you know very well, you sound very bullish on it. And then we have iron ore, which is very capital intensive. You're a new entrant in that business. You've said that you think that there will be a supply response from major producers as demand gets better. When you consider acquisition opportunities in coking coal versus organic growth and investment in iron ore in general, what makes you lean toward the investment that we've seen in iron ore rather than acquiring coking coal producers?
For us, it's we haven't made an explicit trade-off against not acquiring coking coal producers. I think we're quite judicious and cautious when we make acquisitions. We do have a long track record of making acquisitions and paying what we believe is the right value. These iron ore opportunities came up. We are very confident in terms of the growth of that sector. And I think that last graph that we showed demonstrated categorically that we've entered into a position where we are sitting on 7 billion tons of resources at a very low entry cost. So relative to other opportunities around the world in iron ore, this has been fantastic, and it's taken many years of sifting through opportunities to identify that. But we haven't traded off any specific coking coal or other opportunities to do that. I think, as you heard at the beginning, our balance sheet is in fairly good position at the moment, and we aren't at the stage yet where we're won't do that. All of these projects are giving us pretty good returns.
Before we move on to Mick, I just wanted to thank our CEOs for tearing themselves away from all of this wonderful work that they've been doing, and also flying from all over the world to be with us. I think it's certainly been wonderful having to hear it from the proverbial horse's mouth. We'll move on now to Mick, who will close the proceedings. Thanks to all of you for your attendance today.
Good afternoon, everybody, and again, let me join Traz by thanking you for being with us. I mean, Xstrata's run from a point of view of having a conviction, and we have a conviction about the demand side and the supply side of this business. We have our conviction about our capability of delivering into that demand side. We have a conviction of our ability to create value, and that's been the story of Xstrata since 2002 when we IPO'd in the London market. And it was the story of Xstrata in beginning of 2009 when we did the rights issue. The rights issue was a decision made out of strength, not out of weakness. We could easily have cut back on our CapEx program, delayed the projects, conserved more cash at the centre, and got away without doing the rights issue. But because we had a conviction in the super cycle, the stronger for longer, the fundamentals of demand versus fractured supply, we believe that would be a foolhardy thing to do, and that we should forge ahead with the projects, and to do that with a balance sheet from a balance sheet of strength, created the decision to do the rights issue. That undoubtedly was the most sensible decision that we took, because it puts us in a position now to essentially take value out of a world which is demonstrated by these graphs in front of you. China, India, the drivers of demand for commodities, sit right at the bottom end of those intensity curves. A long way to travel up the curve still, in a process of urbanization, which is taking people out of rural areas and putting them into urban areas, requiring all the things that base metals, platinum, nickel, etc., are required to deliver utility to this newly emerging urbanized sets of populations.
And it's that intensity of commodity usage which drives demand and which places both India and China and the rest of the developing world in such a dominant position when it comes to commodity demand that the OECD is almost an irrelevancy. They provide great comfort to us when they're in growth, and they don't give us a sense of foreboding or a sense of risk when they are not in such prodigious growth. If you look at the impact of population growth and energy demand, again, in terms of our coal business, the story, I think, is very powerful as well. In fact, I think, I'm sure Peter would have mentioned to you that China today builds every year the capacity of the United Kingdom in terms of installed capacity. And that is going to continue because of the energy requirements that they require. So the bottom line is that Xstrata offers not an attractive exposure, a powerful exposure to mid and late cycle commodities, which is the fundamental of the story that we have in front of you, with a system which is unable to meet that demand very easily. Again, if you use copper as a great proxy, if you look at the grade of existing copper mines and the precipitous decline of that grade, clearly all operations are running harder, are building additional milling facilities, additional concentrator facilities, but essentially are processing ore which has got smaller amounts of contained copper than they had previously. They're running harder to stand still. And there are no great Escondidas and Grasbergs coming into commission in the next few years. And that means that, that we have a situation where supply is going to always be falling short of demand. And this is not only just in copper, this is across the industry as a whole, although there are some exceptions. The important thing is where Xstrata is placed in this particular setup. And we have this exposure to copper, the exposure to coal, the exposure to nickel, which is very, very significant in terms of benefiting from the problems on the supply side. And if you look at on thermal coal lives, and I know there would have been a big debate, and again I'm sure Peter would have taken you through the issue of the future of coal in a world which is concerned about carbon and carbon emissions and the advent of shale gas, etc. But nevertheless, look at the great producers of seaborne steam coal. And I'll ask you to look at Indonesia versus Australia. Indonesia, which is the main source of the significant increases in the supply of coal in recent years, it is now, I think, the single largest exporter of coal, has a relatively small amount of coal life existing in its current reserve base compared to Xstrata. And that, I think, is a very significant and telling compared to Australia. And that is a very significant and telling point in terms, again, of where we are placed to deliver our coal. Our coal will come from Australia, South Africa, and Colombia in the main. And we are well placed in terms of sourcing that supply in a world where energy is going to continue to be sought after and is going to have structural shortages. So if you look at the phase of Xstrata, essentially, you know, we're in a process of mergers and acquisitions. We were ahead of the game in that. We've always been ahead of the game in terms of deriving and driving operational excellence, where we take the existing footprint and try and create in that footprint greater amounts of commodities at lower costs. And that is something that we've been doing significantly every single year with the declining real costs of production. Every year since 2002, we have had a declining cost in production, whereas our competitors have struggled to do that. And now we're in a situation of delivering value through organic growth. So if you look at phase one, during the time frame of the mergers and the acquisitions from 2002 to 2003, it was creating the optionality in the business. We started with a business which had no optionality at all. So by buying the companies we bought, we created optionality. And then from 2003 towards 2008, 2009, we had to enhance that optionality. We had to take that optionality and use it to create serious and viable projects. And now we're in phase three, which is really delivering on that optionality. And the very significant examples of growth that you've been taken through today are as a result of those three phases. And it puts us, I think, in a situation where we have once again replicated the first mover advantage you had when we were doing M&A, we've replicated that in organic growth. We have a world-class portfolio that doesn't require further embellishment by me. We have in our growth portfolio the next generation of tier one assets grown from these existing asset bases. We've struck the right sort of alliances with engineering capability and capacity, and we've preemptively locked up supply of concentrators, supply of tyres, supply of trucks, etc. So we've allowed ourselves to benefit not only from the existence of the projects, but also from in terms of delivering of equipment to meet those projects. And we've benefited from the Xstrata decentralization philosophy, where we have decentralized our project skills into the businesses. So the businesses have the capability of delivering on those projects and are building up over time a serious capability based on current sets of experiences. And we also have created in Xstrata the cross-pollination of experiences across the business units. The power of the model is that the organogram is strong and powerful for instructions, but it's porous and weak for the sharing of information, and that's exactly how we want it to be. So if I look at the two graphs at the bottom of this presentation, you will see in front of you, and again using copper as a proxy, the approved projects of copper driving production through to 2015 along the solid blue line. And you see the comparison to the other majors in copper and what the nature of their production is likely to be over the next period of time. And it demonstrates a very significant advantage in a very significant commodity, which today I think is trading in excess of $9,000 a ton of copper. And if you look at the number of approved projects versus the project pipeline of Xstrata versus the competition in our industry, you see once again we are advantageously placed that our pipeline is more or less approved. We essentially have just a couple of projects during the course of next year which will close off this pipeline into a totally approved and committed pipeline. And we are therefore very confident of delivery. And because we are confident of the delivery, because of the skill base we have to deliver, the way we've scheduled the projects, the way we've locked in engineering capability and capacity, and the way we in fact have sourced equipment and plant to meet that project development. It's a very powerful position. Now, clearly there remains project risk. And so the risk of Xstrata has shifted, I think, perhaps from the early years where our biggest risk was integration risk. Let's assume that we knew how to buy, we knew what price to pay for the assets. The biggest risk we had was to integrate those assets into our business in a seamless way. Today, our risk is clearly delivering those projects effectively and efficiently. And perhaps one additional risk allied to that is as our existing operations in some of our businesses reach the end of their lives, clearly we need to be very circumspect in how we operate those operations to make sure that the usual things that you associate with end-of-life mines are managed in a way so we don't get significant supply interruptions waiting for our projects to kick in. And so the organic growth progresses well, progresses strongly, progresses prodigiously. We have 20 projects in construction right now, something like 266,000 tons of steel in construction. I'm told there's something like 38 Eiffel Towers as a piece of trivia, which is not going to take you very far. But nevertheless, if you want to write it in your research, give us some spice. 30,000 people, both employees and contractors, working on the projects right now. 30,000 people. We have some 16,000 years of project experience in our management teams across the businesses managing those projects. And we have some $14 billion of construction that is taking place right now. And there's some $8 billion in projects with expected near-term approval over the next year or so. And that's reflected in the volume growth that you see on the right-hand side. And so if you look at coal, we're looking at 43% growth in volumes, copper 36%, nickel 168%, platinum 144%, and zinc maintaining its current volumes because zinc has grown so prodigiously in the last few years. Santiago, as he explained to you, took some very unremarkable assets, and he and his team have converted them into remarkable performers. And so we have here this combination to achieve that 50% target that we've been talking about. So first there's transformation through buying the right sort of things and operational excellence. And now we're achieving through this portfolio of project development a transformation as significant as any major transaction could be. And we feel it's a transformation which is within our hands to control. Whereas nowadays, because everybody has religion, your ability to control value when you do an acquisition is not what it was when we started out. But here, the control of the value addition sits in our hands. If we, in fact, put these projects in on time, on budget, bring them to conclusion, get them running and commissioned, that value is assured. And that is something we feel very confident about. And that value is based on some very conservative long-term price assumptions. It is not based on achieving and maintaining the sort of prices that you have in the market today, although one could construct a very good argument why prices will remain above long-term prices for some considerable period of time. And that will lead, I think, to something like 13 Tier 1 assets developed and enhanced, a 20% reduction in real costs, an average of 22% return on investment on the approved projects at these long-term prices, 50% growth in volumes, and something like $12 billion worth of NPV for the projects which have currently been approved. And I think that's a very significant transformation indeed. And at the same time, we still have further optionality in the system. We have something like 25 additional projects across our business which are in different stages of feasibility or scoping. Now, some of those will not see the light of day. Some of those might not be developed by us, they might be developed by others. We might just capture the value at a different stage. But a significant number of those remain to be developed by Xstrata at some stage going forward. And we have something like $1.3 billion budgeted over the next 5 years to advance the feasibility and scoping of these options across the group. I think from that point of view, the future for Xstrata in a supply-constrained world is a very, very significant one. So the conclusion I leave with you is that Xstrata is incredibly well positioned to benefit from the growth profile and from the commodity mix which is geared towards the rapid rate of urbanization taking place and the industrialization of the populace of developing worlds. It is an industrialization which is following predictable patterns. It is industrialization which is only abnormal by the sheer volume of people involved in the process. Other than that, it is bulk standard industrialization and urbanization has taken place throughout the ages, and we will see the benefits from that. And real price increases associated with massive urbanizations and industrializations took place in the latter part of the 1800s, early part of the 1900s, the United States industrialized, post the Second World War and the reconstruction of Europe and Japan, and it is taking place now in a very similar way as well. And so we feel very confident about this organic growth pipeline, and we feel very confident that that, combined with our operational excellence and continuing to drive the notion that every day you can run your business better than you ran it yesterday, will create more and more value for shareholders for Xstrata. Now, the question is always asked, I mean, does this mean that mergers and acquisitions are off the table? And clearly, they are never off the table for opportunists, and we have always styled ourselves as opportunists. People have a very clear idea of what will create value, but essentially wait for the opportunities to present themselves. And when they do, we try and act decisively and to capture them. I think that on-market acquisitions are quite complex and quite difficult to do. I mean, even the small little transaction that we did in Australia, Sphere, became an absolute nightmare. We were fighting the market. We weren't fighting a competitor. But off-market transactions clearly are more credible and more realistic. And so mergers and acquisitions are not off the table, but the focus of the transformation of Xstrata is our organic growth, and that is a very significant thing indeed. So, given that as the basis of Xstrata going forward, there isn't much more that I can actually say to which has not been said by my chief executives and by Trevor. We have a clear path to value creation within the control of this management team. And I'm very happy to take questions right now.
You stated you think you're taking a lead perhaps amongst your peer group in sort of organic growth. Do you think, just as we saw back in 2007, there's going to be a big catch-up in inflation, a lack of availability coming through again in trucks and drill rigs and that sort of thing? Or do you think it's going to be slightly softer this time, given the pullback that we saw in 2008?
No, I think that the pressures on costs and the competition for contractors, the competition for engineering consultants, the competition for consumables and all the goodies that go into a project is going to in fact increase, and that's why I think it's so important how we have positioned ourselves here to do that. The fact that we pre-ordered concentrators and we pre-ordered mills on the basis that if we didn't use it on one, we use it on another, and if the world changed and we didn't want to use it at all, there's somebody out there who's going to use it. That we've established sort of primary status with the providers of trucks and the providers of tyres to put ourselves into this position, that we've created the relationships with the Bechtels of this world, so ensure we have the A-team with us on these operations. So I think we try to, in fact, put ourselves in a position where we could cope with a world where there's going to be increasing demand for the goodies that go into construction. I have to say to you that I don't know how prodigious and how emphatic this is going to be. Clearly, capacity is greater among suppliers than it was in 2007. But there will come a point in time when it catches up. Now, I think that many other mining companies are going to push as hard as they can to get their projects in as soon as they can. But they are constrained by the fact that every project has a timeline it has to follow. So I think that at some point in time it will catch up. Hopefully the measures that we've put in place will enable us to complete our projects on time and on budget.
Ephraim Roy from Morgan Stanley. You do mention that you are opportunistic in your M&A, but again, I guess being a large diversified mining company, you also need scaled businesses. And I can probably identify two businesses that are not quite up to scale. One is platinum, if the rest of Lonmin doesn't get bought, and potentially iron ore as it stands. How long do you, what's the reasonable time frame for these businesses to remain subscale before you make a decision on remain or exit?
Well, we're not going to exit iron ore. We've just got into it, and we're not going to exit platinum either. I mean, we have every intention to build these into, as you use the word, scale businesses. But again, we have to wait for the opportunities to do that, and we can't contrive transactions to create size, which in fact destroys value. And that is at foremost in our minds. So we have a degree of patience in doing that, which is not normally associated with Xstrata. But as you mature, you learn new skills. On the issue of iron ore specifically, I mean, we have recognized that it was very difficult to make a big splash entry into iron ore. And so we were concerned that our entry point had to be clearly on a project, but we wanted to make sure that our cost of entry into those projects was low enough that if things, in fact, did not work out the way we wanted to work out, it would not have a significant impact on the business. So I'm comfortable that the option that we have in Zanaga and the acquisition of Sphere with its 3 projects, which are available to be developed, that our entry costs are very, very low. And we now face simply with the process of actually building those projects. And clearly, the first 2 projects at Sphere are the most current and imminent. which we will be building as soon as we have got our team in place and we start through with the process. So I think iron ore will take a while to build up into a scale business, but I think that we are confident that we can do it, and we will be prepared to run the course.
And just pushing the point on platinum, what's your patience timeline on Lonmin?
I have infinite patience with Lonmin. They're nice people. Look, it's an option. I mean, it's an option which came about in unfortunate sets of circumstances, and if I could play that hand again, I would play it differently. But it's not an option which costs us a huge amount of money, and it's something that I think eventually we will be able to turn to value, but we have to wait for the right set of circumstances to do that. And I think that's as much as I can say at this stage.
Sorry, just one more. Is there room for a return of capital in all this, do you think?
Well, I think if you look at our projects, which are very significant, there is always room for return of capital if your price assumptions are below what the market ultimately delivers. So our view is that we will take a sort of 6 months view of our capital. And measure that against how far we are completed down the project. Because the last thing we want to do in a situation where there's a temporary decline in prices and you're right in the middle of your project build and having returned a significant amount of capital, which is then say, gee, I need that back. So I think from our perspective, we will measure the time, how we are progressing through the projects versus revenues earned, and take rational decisions as we go through that progression. Have we got a microphone?
Yeah, hi, thanks. Olivia Kerr from UBS. I guess we've talked a lot about sort of the positive outlook for Xstrata and the sector, for the next couple of years. In your mind, what is the biggest risk that we should be thinking about? Is it the issue of sort of resource nationalisation, China tightening, cost pressure, labour shortage? What really worries you the most?
No, I think actually your first one is probably the most significant risk of the industry face, and that's what we term resource nationalisation, where effectively people are using, or governments are using tax to claim a greater share of the rent, essentially becoming your partner without making a contribution. And I think that's a very, very significant risk. And that is why our response to what the then Australian government tried to do was so strong, because if Australia had done it in the way they wanted to do it, I think that would have led to a very significant precedent being set around the world. But I think that's an issue that we all face. And you only have two ways, I think, of combating that. In an environment where most governments are short of revenue and are looking to source revenue, and they will look to the weakest link. And the weakest link has to be people who have invested money in a country, in a resource in the ground, and the only way they can extract the resources is to stay in that country, versus people who have invested in intellectual property. So people who invest in intellectual property can remove themselves from a country and take that intellectual property with them and move it to some other place. We can't. So we clearly are the target and have to be rationally, be a target. If I was in the government, I'd be asking who I go after. Our only defence is this. First of all, that if you're a diversified mining company and you have a wide variety of geographies you operate in with a large number of potential projects to invest in, if somebody believes that you are a credible investor in their country and a creator of jobs and a creator of wealth multiplier by virtue of the investment activities, they will be disinclined to irritate you than irritate somebody else. So I think that that's the one defence. The second defence is your relationship you have with the communities in which you operate. Now, we invest a huge amount of time, and not always successfully, but most of the time successfully, in creating a relationship between ourselves and the communities which covers a wide range of strands which are important to them, whether it is employing people out of that community, providing healthcare facilities, education facilities, recreation facilities, ensuring that there is a momentum to the town. If you look at Isa, the rejuvenation of Isa, as a result of us being there and rejuvenating the copper and zinc complex, has transformed that town into something which was a dying mining town into a vibrant centre of communal life. Now, if those communities feel that an attack on you is ultimately an attack on them, they will be your best form of defence. And indeed, that's what happened in Australia. And that's what will happen in Peru. And that's what will happen in Chile. And that's what will happen in South Africa. Now, it's not a perfect defence, but nevertheless, it is a defence. And those are the two things that we have to work on. That broad license to operate that you gain from communities by bringing a corporate citizen, not just a responsible but a contributing corporate citizen. And the fact that you must continuously project to countries that you operate in that you have other options for future growth. And if you can get that right, you can perhaps stave off some of it, but you won't be able to stave off all of it. I'm not that fussed about the macroeconomic scenario. I mean, I'm sure all of us can construct areas where China is going to sort of contract a great deal, and that will impact clearly demand for commodities, and we can construct other scenarios. But in my view, if I look at an across-the-board view of the dynamics and the drivers of China, India, Brazil, Indonesia, etc., I come to the conclusion that it's a reasonable base case and a reasonable risk associated with the base case that they will continue to be prodigious seekers of commodities as the economies transform. And I have absolutely no doubt that there's no new supply which is suddenly going to materialize overnight from any front which is unexpected. We can study.
John Tomasa is Very Independent Research US. I'm your shareholder and fan.
Oh, good. I'm pleased to hear that. I mean, I've had some people writing about me recently who weren't fans, and so having a fan in the audience is very, very welcoming. Thank you.
There was some, I guess, discussion earlier this year about a merger with your shareholder.
Are you sure you're a fan?
It would seem like that 34.4% block would be a wonderful potential acquisition to buy back. And there are $24 billion of assets on your balance sheet other than your three largest businesses, copper, coal, and nickel. Would it be attractive to offer that shareholder a subset of your smaller businesses, an asset swap to buy back the 34%? I could think of it as simplifying the company. Not that you don't do a great job of running it, but some of us aren't as smart or energetic and don't appreciate the virtues of all the different pieces. It would also eliminate the market uncertainty that those potential discussions might frighten some shareholders.
Well, I think the short answer to what you're saying is it sort of assumes that there's a seller there. And I've heard nothing from Glencore which tells me in any way that they are a seller of our shares. They've never hinted at it. They've never offered it up in the course of conversation. And when asked about it, they have said emphatically, we are not sellers of Xstrata. The shareholders who think back to the rumoured transaction over Vale, we surely must have got a hint there what Glencore's position is on the Xstrata holding. So I think it's an interesting concept, but it's a concept that doesn't fly if you don't have a seller. I appreciate that the role of Glencore as our major shareholder has become much more vexed in the minds of institutions in recent times. I have to say to you that they have always been a very supportive shareholder. And it is unfortunate that in 2009, when we did the rights issue, that some shareholders took a jaundiced view of the complexity of that rights issue in association with Prodeka. But that doesn't take away from the supportive nature that Glencore have been as really key cornerstone investors in the growth proposition of Xstrata. I think we just have to wait and see how things develop. Clearly, our relationship with them is dynamic. Their own situation is dynamic. And we must wait and see how it develops. But you can be sure of this very important point, that this management team and the independent directors on the board are clearly focused in on this issue of governance, on the rights and the rights of and our duties to the 65% shareholders who are not Glencore. And nothing that will or may take place which is agreed to or strategized by the management or the board will have anything that is other than as a core, a thought and fundamental issue. And the second point you must take into account, that the newspapers have written about a lot of conjecture. I can tell you now that I have not had one proposal from Glencore suggesting that they merge with Xstrata. I haven't had a proposal to consider. If they make that proposal, then like everything else, it will be considered, but in the context of what I've just said, what is in the interests of the 65% shareholders. Okay, well, if there are no more questions, then I guess it just leaves me to wrap up and say once again, thank you very much for attending. We hope you found this to be a good day. We enjoyed, I know, getting up our papers ready for the presentation, because we think we have a powerful story, and we hope you appreciate that we do have one as well. Thank you.